Welcome to the first of my afternoon Wednesday series of webinars. This is the first of 5, and in it I'm going to be answering questions about investment real estate. And in the Tuesday night session we have the guest speakers, and I'm going to do my best to cover their topics or their slides, but I'd like to keep this to 30 minutes so you can get back to work. So first, I was curious what brought people to learn more about investment real estate, and also tell you why I'm passionate about investment real estate for my clients, and talk about why real estate versus other investments. Chris Coyne is our insurance guest speaker, and I'll be reviewing his slides on how to manage risk with insurance. I'm going to make a plug for Hosts for Hospitals, which is a charity that I'm passionate about that allows us to use the extra rooms in our houses to host people who are visiting the medical facilities in Philadelphia, so that they can keep their costs down while they're getting medical treatment. We'll look at the series schedule, and if anybody has any questions, you can either raise your hand using the chat box during my talk, or at any time. And then at the end, the PowerPoint, which is also available as a handout, is available for download, and you can have all the contacts, the guest speaker's contact information there. All right, so you're here because you want to learn how to fund your retirement. I'm here because I know that I can help clients do extraordinary things with real estate, like pay for their kids' college in cash when the time comes, or fund their retirement. And I'm curious, I'm going to launch another poll to see if you own any real estate yet, or if buying your first home is the first step. So check out the poll. And looks like you still rent. All right, cool. So the first step is really to get your own home. And see, 100%, good job. And then lastly, obviously you're gonna own your home first, but just out of curiosity, what have you heard or what do you fear about becoming a landlord? So feel free to answer those questions below. You will get sued. Okay. Yeah, liability is a huge component of owning a property because it is a relationship-based business, and there's a physical component to it, obviously. And when people get hurt, they get mad, and we're in a very litigious society. So having insurance to the hilt is really important, and it's not even that expensive. So I'm just going to share a few of the things that I've experienced in the past 18 years as a landlord, and all of them have been managed. They were all solvable with some money and repairs, and a little preparation goes a long way, because when you have a good relationship with your tenant and they know that you're there for their best interest and it's a mutually beneficial relationship, they're going to trust you when you say, I'm going to take care of it. So I've had 2 major roof leaks where there was nothing to be done at the time. The snowstorm had to abate before we could get the roofer out there. The latest phone call I ever got was 9 p.m. on a Friday night, and we just had them put buckets under the ceiling to catch the water, and then I got the roofer out there as quickly as possible. And then after Hurricane Sandy, I had a big roof leak, and again, because I had a good relationship with the tenant, then we were able to handle that. Let me see, is there a question? Okay, I thought I saw a question. All right, and then another time, these 2 tenants I didn't have such a great relationship with. They were a little belligerent, but we resolved it. One had a cat that peed in the basement, and since then I don't allow tenants with cats to have them in the basement. I want the litter on the first or second or upper floors, because cats, when there's dusty basements, they like to use that as a litter box. In this case, he fought me to keep his deposit. So I was like, you know what, it is not worth it. Like, I don't want to get sued. Like you said, I don't want to get sued. And even though I know I'm in the right, I'll just take care of it. And I was able to, get the smell out. And then the dryer fire was actually something recent that happened. And because I have my property managed with JG Real Estate, he'll be on one of the future calls. They were able to, the tenant called 911, they called the management company. The management company told me what they had done to resolve everything. And it's getting taken care of. So in 18 years, these are the 5 things that jump out at me as issues that have come up. These are the biggest, worst things that have happened. And again, an ounce of prevention is worth a pound of cure. And that's the great news about real estate. There's an adage that goes that you make money in real estate when you buy, not when you sell. And so it goes when you rent a property. Your best experience is going to be when you do all the preparation up front. You provide the tenant with the best possible condition in the property. You set the stage for a really good, respectful relationship. And then you have really strong lease terms. And you've done your background checks on the tenants. So the more you do up front, the better and easier everything will go. So I'm super passionate about investment real estate for my clients because of a couple of things that I saw. Number one, 2 years ago, I was doing an analysis and I compared what my stock portfolio had done in the same time frame that my real estate portfolio had done. And my real estate had grown 700%, whereas my stock grew like 25%. And I was just like appalled. And I realized, looking around at all my clients, they're having their second and third kids. And I'm thinking, you guys need to access the equity in your home. You need to get yourself another property, because in 15 years, if college is as expensive as it is today, what is it going to be like in 15 years when your kids go to college? And today, people who are recent graduates who have student debt, they are being impacted from buying homes. So if it's hard enough today for kids or young adults with student debt to set themselves on a path for home ownership and building wealth, how much harder will it be in 15 years from now? So as the Chinese proverb goes, the best time to plant a tree was 20 years ago. The next best time is today. And fortunately for my clients who have young children, today is 20 years ago. So, Grant Cardone says you can't save your way to $1 million. And I just really want all my clients to understand that you have a property now, you've lived in for 5 years or so. Now's the time to get an investment property so that you can have your tenant pay down the debt. You can borrow against it when your kids are ready to go to college, and then your tenants can pay it back. Also, I was astounded by the fact that 1 in 4 people, or 1 in 4 homes rather, in these 2 zip codes in Philly are owned by landlords. They're rented out. And I started investing as a single woman at 27. So if 1 in 4 homes is owned by a landlord, and I as a single woman, and I'm still a single woman owning, a bunch of properties, if I can do it, I didn't have any special training, why can't you? And a lot of times I find that it's the fear of the worst case scenario, what is possible versus what is probable, that holds people back. So I'm, passionate about sharing my experience, because it's not all the hype that you might hear. Learn from me, because I've gone through it, and I'm here to help you go through it too, so that you can have the best possible advantage to creating wealth for you and your family and your future. And of course, use my Homekeeper app to access all my great contractors and service professionals to help you throughout the process. Most investors I know learned how to do real estate investments by just doing it and having good advisors around them. And so we're here to help you do the same. When I started, I had my realtor, I had books that I read. I wasn't a real estate agent at the time. And what I did was I picked an area I felt comfortable with and that my real estate agent felt confident in. And I knew what the rental rate would be. I was able to project what somebody would pay in rent, and I knew what my monthly payment would be. So a good ratio is 70%. If your rental payment is $1,000 or rental income is $1,000, you want to make sure that your rental pity payment or principal, interest, taxes, and insurance is no more than $700. That gives you enough room to save for repairs. I personally bought in my personal name rather than using an LLC. A lot of times people want to do LLCs for additional protection, and then when they realize the interest rates are higher, you might have to put more down, and the amortization period, the time over which you have to repay the loan, is shorter, which makes the payment higher. Then they usually back down and say, you know what, I'll just buy it in my name and do what I did, which was insure myself to the hilt with maximum liability policies and umbrella policies to increase the liability limits. Of course, your tenant screening process and the lease terms need to be airtight. And, also trust your gut. I've trusted my gut, when interacting with people, they will tell you who they are when you meet them. So trust the way they're treating you through every interaction, and how prompt they are and eager they are and respectful they are throughout the process. And lastly, build good relationships with your contractors and treat them well, because they're the ones that are going to help maintain your property for you. So why real estate? So there are 5 main reasons why real estate is awesome. Number 1, tax benefits. So the first thing is that the government's going to give you a tax benefit based on your interest payment to your mortgage company. And then the second thing is that you're going to build up the equity as the tenant pays down the mortgage. So every month you're paying principal and interest. So when the tenant is paying the rent and you're paying the mortgage, over time, if your property doesn't even appreciate, you'll own 100% of that asset after the mortgage is paid off, or 30 years, or whatever the term is. Appreciation. Oh, I forgot to mention with taxes, as a property owner where you live, you don't get to deduct certain things like repairs. As an owner of a property, because it's a business, you can deduct repairs, you can deduct management fees and things like that. So you want to talk to your CPA about all the tax benefits and deductions of owning a rental property and how it might impact your taxes at the end of the year. Okay, going down to appreciation. Historical appreciation is 3 to 5% a year. So the old adage is every 10 years, property values double. So the next thing is cash flow. We talked about making sure that your mortgage payment is about 70% of the income. And then leverage, because you're buying the property as an investor with maybe 20% down, you're owning an asset that's worth 5 times the amount. You'll see this asterisk next to equity buildup, cash flow, and leverage. So when you buy a property, those are the only things that you really can control or anticipate. You can see the amortization schedule and see every month the principal balance that you owe and the equity that you own in the property. Cash flow, by doing our analysis together, we can anticipate what the rental payment would be and what your cash flow will be based on the rental income and your monthly payment. And then leverage, just by virtue of knowing that you're putting a percentage down of the asset's value, you're getting the benefit of leverage. Appreciation and taxes are like the icing on the cupcake or the gravy on the meatball. Because the government controls the taxes, the market controls appreciation. And the way I bought real estate, fortunately for me, I did not understand this when I bought. I just bought in a great area. I bought for the exact wrong reasons, yet I lucked out because I got into a good area, but also because my intention was never to sell these properties. My intention was a long-term investment. And that's what got a lot of people into trouble when they were flipping properties. They were in it for a year, 2 years, 3 years, banking on appreciation. I knew that if I got a property, my intention was to keep it. So you want to think of this as a long-term 15, 20, 30-year proposition. And for those of you who joined us late, welcome. Please raise your hand or write a comment in the chat box if you have any questions as I go. Feel free to interrupt me. I'm trying to look at the camera as much as possible, but I'll keep looking down to see if you have any questions as we go. So now on to stocks as compared to real estate. So when you buy a stock, you are doing dollar per dollar investing. Whereas, so if, for example, you're buying $30,000 worth of stocks, that's the value of your stocks. If you're buying real estate, $30,000 will get you a property that's worth about $100,000 if you put 20% down and then reserve $10,000 for closing costs. Now, if you look at earnings over a period of time, $30,000 will double in 10 years at 8%. If you buy a house at $100,000, your $30,000 investment will double at only a 3% appreciation. So your stock portfolio needs to outperform your house appreciation by almost triple the amount in order to yield the same amount. And also, unless you know about like stocks and crazy advanced things on Wall Street. I don't even know the terms for them, but I do watch Billions, great show. If you don't understand an investment, you shouldn't be involved in an investment. Real estate is so easy to learn, and it's easy to teach. And you know, the main thing is that you get to keep the asset in order to borrow against it. So if you wanted to use the new equity in the home, you just borrow against it and you keep the asset rather than having to sell it like you would a typical stock. And then also, businesses come and go. I don't know about you, but it would be better for me to do my day job than to learn how to invest in the stock market. And versus investing in real estate, if let's say you're a marketing consultant, you need to live somewhere. So the first step is to get your own home, and everybody needs a home. So that's pretty easy to understand. And when you have professionals like me to help you, and the advisors that I surround myself with, we can help you manage the risk and make good decisions along the way. So earlier I put out a poll to see how many people owned properties and how many were still on their way to their first home. So the first step in building wealth with real estate is to get your first home for yourself. And this is what I call the $1.2 million advantage, because after 30 years, if you were paying $1,000 to start in rent, you would end up spending $570,000 if your rent only goes up by 3%. Chances are, if you move at all, your rent is probably going to go up more, and chances are you're not going to go for cheaper rent. So this is a very modest estimation of what it would look like to start today at $1,000, and then in 30 years you'll have paid $570,000 in rent that you'll never get back. You essentially bought your landlord a property. As a homeowner, when you become your own landlord and you apply that same $1,000 monthly payment for the principal and interest, and with 4% appreciation, which is in that historical average, you will then own outright a property that's worth $648,000 after 30 years. So let that sink in for a minute. If you rent for 30 years, you are at a deficit of $570,000, but with that same payment, you are at a positive $648,000 after 30 years. So step one, get your own property. And then step two is like a lot of my clients are doing, which is number one, if they already own a home and it's been a couple years, they either move up and convert their rental into or convert their primary into a rental, or they're doing what I call splitting their equity. They're taking a home equity line of credit out against their principal residence and using that to buy an investment. So I have a couple clients that are currently doing both right now, and they're both really excellent opportunities if there's enough equity in your current primary to take money out, or we can look at what the rental payment would be when you convert your current primary into a rental. So the key difference is in which strategy to use is if you still love your home and your home still suits your needs, then it would be better to take equity out and then buy a new rental property. But if you're feeling like, our family's growing or we're outgrowing our one-bedroom condo and we want a bigger space, well, that's a perfect opportunity to do a move up where you're converting your current current primary into a rental and buy a new primary. And the cool thing about that is because you're buying a new primary, you can put very little down to get that new primary, so long as you don't, like, for example, you can use an FHA loan on your new primary, which only requires 3.5% down. As long as you don't currently have an FHA on your primary. So, as your agent, I would walk you through the mechanics, all of this, and run the numbers for you. And on this slide, the homework would be for before 2 weeks from now would be to email me your primary address, how much you owe, what your monthly payment is, and if you have additional cash assets for the purchase, and I would run some preliminary numbers for you to figure out what a scenario would look like for you. And then just a quick overview of the 6 easy steps to building wealth in real estate. Number 1, determine your purchasing power. Number 2, identify areas and property types that fit your budget. Number 3, visit and analyze properties. Number 4, make an offer. Number 5, do your inspection and other contingencies. And number 6, prepare to lease out the property, whether it's your primary that you're converting or your new property that you're buying. And together, we would work that all out together. So, does anybody have any questions about what we have talked about so far? feel free to interrupt me as I go on to. So Chris Coyne was with us last night, and his segment can be seen on my YouTube channel, which is stacylovesrealestate.com. And I'm going to just review some of the things that he discussed. So there are 4 ways to deal with risk. Number 1, you can accept it. So you decide what your deductible amount will be, whether it's $500, $1,000, $5,000, or you can mitigate it. So you can repair your sidewalks, put in hand railings. You can make sure your roof is, up to date and maintained. You can install security cameras or a security system. You can transfer risk. You can make sure your tenant has insurance and adds you as an additional insured for the property. If you're renovating a property, you want to make sure that you get a builder's risk policy or a renovator's risk policy. And there's a difference as far as time factors go in there. And the last way to deal with risk is you can insure it. So you've got liability coverage, you've got coverage for the property, and you also want to make sure that if you have a claim, that your loss of rental income is actually factored into the policy. And normally it's 12 months, but his recommendation is get 18 to 24 months of your rental income covered if there's a claim. So under habitational risk, he specifically talks about making sure that you are properly covered for what it will actually cost to replace your property. If you're insured for $200,000 and your property will cost $500,000 to replace, then you want to make sure you're covered for $500,000. You want to make sure, like I said, about the tenants carrying their own insurance policy, at least $300,000 in liability coverage, and naming you as an additional insured, which is free for them to do, and you can ask them to send you a copy of that. You want to make sure you confirm your liability limits. And then, for example, I have a car insurance policy and a home policy that I've covered by a personal umbrella policy, which only cost me $199 a year for that extra coverage to bring me up to $1 million. And then I have under my rental properties have a commercial umbrella policy that brings my liability up to $1 million, and that's only $250 a year. So it's so cheap to insure yourself to the hilt, especially when you own it in your name, because your other properties are exposed if you don't have each property owned in an LLC. You want to check maintenance, so for example, JG Real Estate, I am so passionate about recommending them for Philadelphia property owners. I've been with them for 3 years now, and they maintain my property so well. Every year they're doing annual inspections, making recommendations. Whenever there's turnover, they're making recommendations. So, you want to make sure that the property's in good shape so that there are no trip hazards and things like that. And then lastly, making sure you have extra coverage in case there is a claim and it's the middle of summer, your contractors are busy and they can't even start the work for 6 months and it takes 13 months to rebuild your property or what have you. When you're doing a renovation or a builder's risk policy, you want to make sure that your general contractor is a general contractor and that they have certificates that they provide you, and you see what exclusions their policies exclude. You want to make sure you're listed as an additional insured, and you want to have hold harmless agreements, and you never want to pay a subcontractor directly, because if you pay them directly, then you might become the GC, and that might nullify any insurance that the GC has over the sub. You need to know if the policies indicate start and stop, when the work needs to start and stop, and any exclusions in your or the GC's policy. Of course, Chris Coyne is the expert in insurance. I am not. I'm just the messenger. So if you have any questions, please feel free to reach out to him directly. He'd be happy to talk to you and walk you through it. And one of his handout is included here that you can download. So to get a quote, you can reach out to Chris at coinec@gcarisk.com, or give him a call, and his contact information is on the PDF of this presentation. So if there are any questions, let me know, raise your hand, put it in the chat box. We have 3 minutes. Just want to bring to your attention, moving along, Hosts for Hospitals. So if you were curious to see how you can participate and provide lodging for people who are undergoing treatments or their families who are visiting patients using our specialized services in Philly, cost them $20 a day versus hundreds of dollars a day for lodging. And you're not required to provide anything other than a safe, clean environment and a place for them to stay. And I've done it. It's super rewarding. All you need to do is email lodging@hostforhospitals.org. The series continues in 2 weeks, the 9th and the 10th. The 9th is 7 p.m. for a full hour with our guest speaker about mortgage. And the 10th, same time, 2 weeks, 2 p.m., 30 minutes. I'll be covering the main points from the night before. And then in 2 weeks from that, JG Real Estate will be on, and we'll be talking about processing the tenant and property management. 2 weeks later, we're going to be analyzing an area and a property for flip or rental, and we'll have an attorney on. And then in 2 weeks after, we're going to talk about some unique ways of using other funds in real estate. Again, any questions, please feel free to raise your hand as I just go through the final slides to let you know what's here. Just as a reminder, if you want me to do an analysis for you to show you a property you can afford based on owning your home, send me this information. Here's just the lineup for the speakers and their contact information and their mugshots. And there's me. And then lastly, as we wrap up, I just want to alert you to kellerinc.com. These 3 books are essential for your library: MREI, the Millionaire Real Estate Investor book, Hold and Flip, which are all about investment real estate. Hold is obviously about rentals. Flip is about flipping properties. And we'll be touching on all of those topics in the coming weeks. So I really appreciate you coming. And I'll just pause here for a moment and unmute you all in case anybody has any questions. You can just raise your hand. All right, trying to do this here. Oh, here we go. Unmute all participants. Shout out to Arthur, high school friend who's on the line. I was so glad to see that you signed up. It's so awesome to see you online. All right, well, it's 2:30. Out of respect for your time, we will end the webinar. If you have any questions, you can reach me at stacy@phillyliving.com or my phone number. Just download the handouts and this will be uploaded to YouTube. Thanks, guys. Bye-bye.